Historical data reveals that a 70% collapse in Bitcoin serves as the baseline for its cyclical behavior. The prevailing professional consensus suggests the $48,000 institutional ETF launch price provides a permanent floor for the market. Surviving the current post-halving environment requires investors to stop conflating standard cyclical corrections with existential macro crashes. We analyze the market through the Realist Framework, a mathematically standard drawdown governed by internal cycle dynamics. This stands in direct opposition to the doomer tail risk, a systemic, macro-induced capitulation driven by broader global economic failure. By unpacking precise on-chain metrics and historical ETF proxies, we can map out which of these two scenarios is currently unfolding. Misdiagnosing the drawdown environment is the most efficient way for institutional capital to get trapped in a late-stage business cycle. The historical taxonomy of Bitcoin's post-halving drawdowns provides the first analytical model. Prior cycles have yielded drops of 94%, 87%, 84%, and 77%. These figures demonstrate a consistently severe baseline of correction, independent of global economic recessions. A standard 70% drop from the cycle's $126,000 top reveals a target capitulation band between $30,000 and $42,000. The primary bullish counterargument claims that because retail euphoria was absent at the cycle top, a massive crash is impossible. The 2019 cycle serves as a rebuttal. Bitcoin topped on apathy during that period, but still suffered a massive drawdown from late-stage business cycle pressures. Predicting price action in the $30,000 range does not require an external black swan event. A price target between $30,000 and $42,000 represents baseline cyclical beta, aligning precisely with the asset's established mathematical history. The most dangerous misconception in the current market is the belief that institutional ETF inflows make a drop below the initial $48,000 launch price impossible. The 1999 QQQ ETF launch provides a structural analog for Bitcoin's current environment. Both assets launched their highly anticipated thematic ETFs at a price level of approximately 48. Thematic ETFs typically launch at the end of bull cycles, appearing only after multi-year hype forces institutional adoption. Post-launch, the QQQ rallied to 120 before experiencing a severe drop, eventually collapsing to 19 during the subsequent recession. Bitcoin's rally from 48,000 to 126,000 mirrors this trajectory. A collapse below the initial ETF launch price has explicit historical precedent. Late-stage thematic market behavior suggests that an ETF launch rarely functions as a permanent structural price floor. We must now transition from standard cyclical behavior to the tail risk macro scenario, a systemic contagion event. This macro fractal tracks global liquidity against the broader equity market. It overlays the S&P 500 divided by the M2 money supply from the dot-com era onto our current data. The correlation is striking. Temporary market sweeps to all-time highs are the standard precursor to massive rollovers. In this scenario, the stock market could theoretically sweep its highs until late 2026 before the actual recessionary drop occurs. A deceptive U.S. labor market acts as the underlying mechanism for this delayed drop. While initial claims remain low and mass layoffs seem contained, hiring rates are quietly plummeting and job openings are disappearing. This creates a chronological trap. Bitcoin could chop sideways or bleed toward $40,000 by late 2026, creating the illusion that the bottom is already in. Just as risk-on buyers pile back in, the stock market finally succumbs to the labor crisis, dragging all assets into a final capitulation. The true macro trap is surviving the localized crypto correction, only to be wiped out by a delayed, systemic global recession. Proving when the bleeding has actually stopped requires shifting from forecasting to quantitative verification. Every major market cycle bottom has been marked by specific on-chain thresholds. The first metric focuses on supply and profit versus loss. These lines must definitively cross to signal a bottom, a signal that has yet to occur. The second metric highlights the gap between the realized price at $54,000 and the balance price near $39,000. Historically, bottoms form only after price action falls below the balance price. Finally, the MVRV Z-score must breach the absolute zero line to confirm that capitulation is exhausted. Attempting to front-run these metrics because of a psychological desire to be bullish is a high-risk strategy. Maintaining a defensive posture represents a commitment to mathematical discipline until these specific thresholds are breached. Our dual model approach dictates a clear path. Prepare for a cyclical drop into the $30,000 to $40,000 range while remaining defensive against the 2026 macro tail risk. Adopting cheerleader narratives that refuse to acknowledge downside risk creates a state of extreme financial vulnerability. In financial discourse, the term doomer is often used to deflect from uncomfortable data. This label is better suited for those who disregard verifiable evidence, the same mindset that disputes the scientific reality of the moon landing. Modeling a 70% drawdown based on historical averages is a data-driven exercise, separate from the anti-science mentality of true denialism. History rewards those who wait for the data to confirm capitulation, rather than catching falling knives on pure faith. Objectivity is your only defense against both naive optimism and systemic contagion in a late-stage macro environment. Subscribe to Whale Radar for further institutional-grade macro and on-chain analysis.